Hello students, and a very warm welcome to this new set of accounts video lessons from the chapter Recording of Transactions, Part 1. This is where, from the introductory theory, we gradually delve deep into the procedures. Throughout the series of lesson videos, we will learn the recording of transactions starting with the very basics. This is a furniture shop, and Tony has been running this shop for many years now. Now his son Jim comes to the shop one day. He's studying commerce. And there comes a customer who purchases a beautiful handmade wooden tumbler. Jim was looking curiously for the voucher pads and such other documents, but to his utter surprise, nothing happened. Now the selling of the tumbler is a business transaction. And why so? Because there are two aspects. One is the passing on the ownership of the tumbler to the buyer, and the other is receiving of the consideration for the tumbler in cash. So now, any such business transactions should be evidenced by appropriate documents such as cash memo, sales bills, invoices, salary slips, and so on. To define a document which provides the first-hand evidence for the transaction which has happened is called the source document or a voucher. It may happen that in any case there may be no document at all, and exactly here the very basic the voucher comes into the play. And that's the reason why Jim was looking for the voucher pad in the shop. Jim quickly draws a specimen transaction voucher to make his dad understand. Jim gets this feel very quickly that now he has to take the entire ownership of setting up everything on the recording part here. Minnie is assistant to dad in the shop. So Jim and Minnie together starts the process. The accounting vouchers can be classified into cash vouchers, debit vouchers, credit vouchers, journal vouchers, and so on. A simple transaction that just happened, that is, the sale of the wooden tumbler, there are simple two sides, one debit and the other credit. So the voucher to record such transactions is known as transaction vouchers. The format is what you just saw. Now say in cases where there are either multiple debits and single credit or single debit and multiple credits. These are called compound vouchers. Following these transactions, which are called compound transactions. This is the specimen which Jim draws. Transactions with multiple debits and multiple credits are called complex transactions, and the accounting voucher which fits this is called complex voucher or a journal voucher. And this is the specimen which Jim draws for the same. Jim has worked as intern before in a mid-sized company. He knows that the design of the accounting vouchers depend entirely on the nature, requirement, and the convenience of the business in question. There is absolutely no hard and fast rule of maintaining accounting vouchers. Business entities are free to use their version of the voucher, which will ensure smooth, proper record keeping. However, Jim and Minnie discusses on the few essential elements that a voucher must contain. The quality of paper used must be good. Name of the entity should be printed on the top. Date of the transaction should be mentioned against the date. It is to be noted that the date of recording of transaction should not be mentioned here. The number of the voucher should be in pre-decided set serial order. The name of the accounts debited and credited is to be mentioned here. Debit and the credit amount is to be written in figures against the amount. Description of the said transaction is to be given account-wise. The name of the authorized person is mentioned on the voucher and signed respectively. Now, we need to understand the concept of accounting equation. Jim and Minnie starts with the concept of balance sheet. And what always happens in a balance sheet, students? The asset side equals the liability side. Meaning, the assets of a business are always equal to the total of liabilities and capital. That is owner's equity. So, it can be represented as A is equal to L plus C, where A is asset, L liabilities, C capital. This equation can be written as A minus L is equal to C. A minus C is equal to L. At any point of time, the equation just mentioned stays intact. Jim and Minnie goes to Tony and he recaps the starting days of his shop. Tony started the shop with a capital of 40,000. Now see, at this point of time, the equation is intact. That is, the assets total equals to the liabilities total here. Now say, let's have a balance sheet after 6 months of operation. Number 1. A bank account is opened with 10,000 rupees. So, in this case, the transaction increased the cash at bank, that is assets, and decreased the cash in hand by 10,000 rupees. Number 2. Bought furniture worth rupees 5,000 with cash. So, in this case, furniture increased and cash in hand decreased. Bought the shop worth rupees 25,000 from a very dear friend who trusted Tony completely and sold it on full credit. So, in this transaction, the shop or building account increased by rupees 25,000 and creditor also increased by rupees 25,000. Number 4. Raw materials were purchased worth rupees 5,000 on credit. So, the raw materials increased the asset side, whereas creditors also increased the liabilities side. Now, the purchased raw materials were worked upon by Tony and sold at a profit of rupees 10,000. Yes, so the materials were sold at rupees 15,000, which was a check receipt. So, in this case, the raw materials, that is assets, decreased by rupees 5,000. Cash at bank, that is assets, increased by rupees 15,000. And the profit of rupees 10,000 was added to the capital, that is liability increased by rupees 10,000. So, here we go and we see the balance sheet being tallied after every such transaction. And we always see A is equal to L plus C. So, students, this understanding, if you could get absolutely clear, every time and everywhere your balance sheet will tally. So, students, we close our lesson here today. We will understand debits, credits, journals, and ledgers in our forthcoming lessons. Till then, wish you a very happy learning.